Hi everyone, welcome back to JMC Legacy Group YouTube channel. My name is Kimberly Rodriguez, CEO and founder of JMC Legacy Group, Accounting and Tax. Today we're diving into a crucial topic that affects everyone, your credit score. Understanding your credit score is how it's calculated and how you can improve it can open up many financial opportunities, especially for small business owners. Now your credit score ranges from as low as 350 and as high as 850. First, let's talk about how credit scores are calculated. Your credit score is a 3-digit number that represents your credit worthiness. It's primarily calculated by 3 major credit bureaus: Experian, Equifax, and TransUnion. Here are the 5 main factors that goes into calculating your credit score. Number 1, 35% is your payment history. Most of the significant factor is if you're paying your stuff on time. Avoid late payments. Number 2, amounts owed, 30%. This looks at the total of your credit you're using compared to your total credit limit. So it's known as your credit utilization ratio, and keeping that ratio below 30% is generally recommended. The lower, the better. Number 3, the length of credit history. That's 15% of your credit score. The longer your credit history is, the better. That includes the age of oldest accounts, the age of your newest accounts, and the average age of all of your accounts overall. Number 4, credit mix. That's 10% of your credit score. That takes into account the different types of credit accounts that you have, such as your credit cards, your mortgages, your auto loans, and student loans. A diverse mix is a good thing for your credit score. Number 5, new credit. That weighs 10% of your credit score. Opening several new accounts in a short amount of time can be seen as risky behavior and can lower your credit scores temporarily. Any new hard inquiries, they usually last for about 2 years on your credit score. Now that we understand how credit scores are calculated, let's talk about some tips for improving and maintaining a good credit score. Number 1, we had mentioned the payment history. That's 35% of your score. Remember that. Pay your bills on time. Setting up automatic payments and reminders will help you to make sure that you never miss a due date. Let's talk about due dates. There's due dates and there's statement dates. That goes into keeping your balances low on your credit card. Number 2. So due dates is when your payments are due and is when you should be making your at least minimum payments for it to be considered on time. Your statement date is when your current status of your account is reported to the credit bureaus. Meaning, if you have an account that you paid off the balance, an emergency happened, you had to use it, you still have like a leeway of 5 days before the statement date, before that gets reported to the credit bureaus. You could use the card, but make sure to pay off that balance before that statement date. Number 3, don't close unused credit cards. Why? Because that's part of your credit history and it's also part of your active open accounts. Active open accounts weighs more than closed accounts. So keep your accounts open, use them maybe a couple of times, put gas, pay it off. It also increases your chances of getting a higher credit limit in the future. If you have self-control, it is a good thing because the higher your credit limits, the lower your utilization, the better your scores will be. Number 4, don't open too many new accounts at once. However, there are certain circumstances where you may want to open several accounts at the same time, but that's for a different topic. Number 5, regularly check your credit reports. You could actually get your free credit report from annualcreditreport.com. Once a year, it is free. I would also suggest signing up with myfico.com or Experian.com to track your FICO scores on a month-to-month or every 3 months. Now that we understand how credit scores are calculated and we went over some tips on how to improve and maintain a good credit score, let's look at why understanding your personal credit is beneficial when it comes to business credit. So the impact on a good credit score and the impact on handling your personal finances means number one, you get to secure lower interest rates. Number two, you get approved for loans and credit cards. Number three, you get access to better credit card offers. And number four, you can negotiate better terms on financial products. So it's a huge leverage for you, especially with small business owners and entrepreneurs that are starting off. Thank you guys for watching, and if you have any questions, please make sure to write it in the comment section below. Don't forget to give us a thumbs up and also to hit the subscribe button and share the link with all your friends. As always, this is Kimmy Rodriguez. See you next time.